Well, emerging country. So let's start. Emerging country, they've been quite resilient to the Eurozone. Even if we see in Brazil a very sharp, very sharp decrease here of deceleration of growth. We forecast 3% growth in Brazil. Well, the first quarter was not that good, but maybe it be less. But at least we have forecast a progression of growth for this year to 5.1%. With the most, you have growth of less than 1%, 1 percentage point in emerging Asia, without surprise, in Latin America, in sub-Saharan countries as well, Africa. I think we are going to speak a lot about sub-Saharan Africa in the next few years. Whereas emerging Europe, you see on the right-hand side, is rather stalling with 1.8%. Emerging market has at least two strengths. They proved with the economic slowdown and crisis that they were able to implement very reactive and very cautious policy, monetary and budgetary policy. They are proving now that they are tempted and capable of protecting their own production fabric by implementing protective measures. With the benediction of the IMF. The IMF said as long as it's for short term, but probably it may last a little bit more. If we are they invulnerable even if they have good growth? Of course, if I ask the question, it's because it's no. And we have listed 5 vulnerabilities for the next years to look after. The first one is, of course, and it has always been, the external vulnerability. You see on the right and left-hand side the GDP growth, and on the basis line, that's the trade openness. That means what do exports represent to the GDP? Without surprise, you see on the left at the top that emerging Asia has managed very, very successfully during last year at least, with Indonesia and Philippines. Despite, because they have a low level of trade openness, so they were not hit by the Eurozone. And Indonesia and Philippines as well has a very stable expatriate remittances, which help growth. On the other side, Thailand and Malaysia, they are very, very open, but actually the growth was quite high. It's thanks to very active budgetary stimulus. And without surprise, on the basic line on the right side, you see that emerging Europe with Czech Republic, Slovenia and Hungary has been very much hit by the commercial channel, as they are very relying very much upon Western Europe orders in order to export. Then you have, we've just seen the commercial channel, and you have, of course, the financial channel. That's a little bit more complex. As you see on the left-hand side, the evolution of foreign direct investment flows to BRICS and Poland and Turkey. The inflows are on the top, the outflows are on at the bottom, and the red line is the net. You see that it's decreasing, but it's not slumping. Actually, it might be, because this is in 2012, it might be increasing a little bit more for inflows, thanks or because of, I would more say than thanks to, the liquidity of the Feds and the Japan. But actually, we see that liquidities are more dedicated to advanced economies, equity, and stock markets than flowing into the emerging countries, than like it was the case for the first QE1 of the Fed in the United States. On the right-hand side, you see the exposure of European banks to major emerging country area. It is too decreasing, but it's not slumping at all. It is, as far as Central Europe is concerned, we probably will not see a brutal withdrawal from this country, because in Vienna there was an agreement between this country and Western Bank not to withdraw flows of investment too rapidly. Then well, the consequence of the external vulnerability is that an emerging country can have a shortage of financing coming from abroad. So it needs to develop its own banking domestic credit market. We put there on the left side a few large emerging countries and the level of the private sector, the credit to the private sector to GDP. And here you have three kind of country. You have at the top China, Vietnam. You see that the credit market is oversized. Of course, it has helped the economic development, that's for sure. But now it is becoming a problem after the big stimulus during the crisis. Credit has flown to public companies, and they have created a lot of investment and overcapacities. So the challenge for China and Vietnam is to limit the increase of the credit to domestic sector, and at the same time to implement good practice in order to avoid to have an increasing of bad performing loans in the balance sheets of the banks. And so that's for the top market. Then you have downside, Argentina and Algeria. They have a very undersized market, domestic credit market, because in Argentina investment is very low, and in Algeria you have a very small private sector compared to the oil rent. And in the middle, you have a few countries where the credit market is reasonable, around 50–60%, but actually it is not developed enough, because you see that corporate external debt, that's on the right-hand side, in Russia, Turkey, and India, has been progressing very, very much. And that's for Coface a risk, because it is due to a very few number of companies, large companies. That's the first thing. And the second risk is that they borrow, of course, in foreign currency, and you have foreign direct investment and in portfolio in this country, which just can withdraw just like that, in brutal withdrawal, if suddenly there is a defiance. It can be the current account balance, for example. So there you have a real risk on a credit risk on the companies of Russia, Turkey, and India. Now, before going to the fourth vulnerability, I think we are at the fourth one, 5. We have 5 in total. I just want to remind you that the public finances of the emerging markets are very good. You see in green, that's the public market of emerging country, and we just put the public market of advanced economy for comparison. So that's very reasonable. And as far as foreign exchange reserves are concerned, they need foreign exchange in order to pay their imports. You see that it's huge, it's $7 trillion. And on this $7 trillion, half is for China. So we get to the fourth vulnerability, yes, the fourth. It is the quasi-sovereign risk. We've just seen now that the sovereign risk, public finance, foreign exchange reserves are very good, globally, of course. So when you have a contract with a company from the public sector in emerging country, you just have to be very, very careful that the formal guarantee of the state is included in the contract. Because we have seen last year and the year before, since the beginning of the crisis, a lot of quasi-sovereign failures. And you have the most famous one, BTA, which is a bank in Kazakhstan, who failed twice. So lenders and borrowers are just playing on the ambiguity. It's a company from the public sector, so it means that if there is a problem, there will be a bailout from the state. But the state doesn't necessarily bail out, because the sovereign risk is good, and the state doesn't want to deteriorate its sovereign risk. So now, the other problem an emerging country can face is the difficulty to transmit. I don't know if it's the word transmission channel. I mean, to make its policy. Economic policy go down to the real economy. And China is a very good example for that. The sovereign risk is very good in China. It has good low-level debt of public debt, very high, as I said, foreign exchange reserves. And here on the left-hand side, you see that especially since the crisis, that's the blue line here, just on here, you see that investment has gone up very, very, very quickly. It's 45% of GDP. That's really too much. And whereas here you see household consumption has declined, so it's 35%, which is too low. So Chinese authorities have decided to shift the economic model, but they have some problem with limiting the credit, and it was said this morning, it was pointed out this morning. Here, here you have the official credit, which is being limited, so that's quite a success. But here you have what we call the social financing or the shadow banking. That's where corporates and households go to have a credit, and it is very, very dangerous for two things, because the interest rates are really very high. They are just like usury rates. And the second thing, it's because this kind of credit just to maintain sort of zombie companies. It creates overcapacity and companies which are not to be trusted at all. So that's a real problem. For the anecdote, households at the moment are just going around the Chinese authority decision to put a higher tax on the selling of a secondary home. So what Chinese people do is that they divorce, they sell the second home, they don't pay as high a tax as they should do, and then they marry again. And you have an explosion of divorces in China at the moment. So this shadow banking, as I said, creates zombie actors, and there are just two sectors, cement and steel. You see that in China, for steel, 5 actors produce 27% of the national production, whereas in South Korea or Japan, you have less actors producing between 70 and 80% of the national production. So be careful when you contract with zombie companies. And the last vulnerability, and not the least, actually it has become very burning, it is the problem of governance. Here you have the methodology of the World Bank with government's effectiveness, rule of law, and control of corruption. You see that some countries are in very bad state from this point of view. It is not new, it's not a new problem, of course, but it has become burning because of the expansion of the middle classes. And these middle classes are more exacting about the way the rule of law is applied, and they ask institutions to be accountable for their acts. That's after the spring, the Arab Spring. We have seen demonstration in Russia after the elections of a presidential election. You have, of course, in India, demonstration against the violence to women, and now you have in Bangladesh demonstration about the insecurity in factories. If we focus on 30 emerging countries with the tools for change, which are the level of education, the equipment of internet, women fertility, and the pressure for change, which are GDP and employment and so on, you just see that in the circle, the countries which are more vulnerable to social tension in the next years. So with our assessment, we have put a negative watch on Poland, Slovenia, and Czech Republic in January because that's in red, and the modifications are in red because of the sluggish growth and their dependency to the Eurozone. That's the commercial channel. We have put a negative watch on the A4 of Tunisia because the transition is very difficult, and we have an increase in payment incident. And in South Africa, we have put a negative watch on A3 because